Hello everybody, welcome to Chapter 2 of Fundamentals of Financial Accounting. Before we start here, make sure you go to SFU Canvas and print out a blank set of notes for Chapter 2 so that you may fill them in as we proceed. So taking a step back to earlier in Chapter 1, we discussed that a major function of an accounting information system is to record transactions. A transaction is any event which has a financial impact on a business and can be measured reliably. A simpler way to think about this is in the form of a trade. You must give up something in order to receive something. To record transactions accurately, we need accounts. Simply put, an account is a record of all the changes in a particular asset, liability, or shareholder's equity during a period. The best way to understand accounts are to visualize all the items we saw in our financial statements. For example, the assets shown on the book to balance sheets are debit accounts, liability and equity items are credit accounts. But what exactly does this mean? The modern day business world relies on a double entry accounting system. This means that any given transaction results in at least one debit entry and at least one credit entry. So this is something that we looked at in our last chapter, where the accounting equation illustrates the debit and credit system quite well. On the left side, we have our assets, and on the right side, we have our liabilities and owner's equity. The assets are known as debit accounts, and the two on the right are known as credit accounts. So as the equation suggests, at all times we must have debit equal credits. So as discussed earlier, the assets are debit accounts, liability and equity are both credit accounts. This means when assets increase, we debit the asset account by the amount of its increase. When an asset decreases, we credit that asset account. Equity and liabilities are exactly the opposite. They are credit accounts. When an equity or a liability increases, we credit the account. When an equity or a liability decreases, we debit that account. Before we go into financial statements and journal entries, let's familiarize ourselves with the idea, with an activity. So take a minute here and read through these 3 quick questions. And in the same video, we will cover them in just 1 minute. Okay, the first question is asking, if an entrepreneur invests $50,000 into a business, what happens to the firm's cash account? So this is a little bit of a review from last chapter, and the answer is pretty straightforward. When you add cash to a business, the cash account increases. And as we know, cash is an asset. It helps the business drive. It helps the business earn money. Therefore, an increase in any asset is a debit. How much? Well, that one's the easiest question of all, $50,000, which was the amount that the entrepreneur invested. And as I mentioned, we have a double entry system. So we know each one of these transactions has one debit and one credit. That's a little bit of a hint as we go forward to look at part B. With any owner investment into a business, we end up with an increase in equity. And when equity increases, it results in a credit entry. And once again, we have the same amount of $50,000. Next question asks us, if we borrow $25,000 from the bank, what happened to the cash account? Well, again, more cash means the cash account is increasing, which is resulting in a debit, an increase to the cash account. And of course, the amount is straightforward, $25,000. And this time, the increase in cash was a result of liability and not equity, since we took a bank loan. And liabilities are also on the credit side of the accounting equation. So that will be an increase, and it will be a credit of $25,000. And looking at the last question here, if the business pays back a loan of $10,000, what happens to the firm's cash account? Well, when you pay back cash, you're losing cash. So now it can be a decrease. And when you decrease a debit account, it's a credit entry. It goes opposite of the account's natural state. And the amount, straightforward, $10,000. And liability. So you're paying back a loan. That means the loan is dropping. So we have a decrease in the amount that we owe to the bank or our lender. And when we have a smaller liability, that requires a debit entry to bring down the credit account. Once again, the amount is straightforward, $10,000. So here you get to see kind of how the debit and credit system works. Everything is always balanced. These questions provide us with a basic idea of how the three major parts of a business are affected by transactions. We use cash as the only asset account. It's the simplest to understand. However, we can see many examples of asset, liability, and equity accounts on a balance sheet. Note the difference in how the equity account is presented when there is one owner, that's a sole proprietorship, compared to a larger firm. In your own business, you would typically show your capital investment as first name, last name, comma, capital. So I'll give you a minute to try this. I'm going to fill my own name in once you have gone ahead and filled in yours. Okay, I'm going to go ahead and fill my name in now. Jazz Singh, comma, capital. Looks nice. However, a larger firm may have capital investments for many investors. Imagine if you raise startup cash for your new firm by selling shares to 20 of your friends and family members. Presenting equity accounts on your balance sheet in the same way we did above, over here, will be a real pain. Imagine a company like Microsoft, which has thousands of unique shareholders. As a result, we simplify things by presenting capital owned by many shareholders as simply common shares. The equity section on the balance sheet of a large publicly traded corporation might look something like this. So we have shareholders' equity, we have numbers in millions. So we have retained earnings, which if you recall is the accumulated profit and losses over the years of that firm at 20 million and change. We have common shares, which are funds which people have invested in the business at 115 million and change. We have total equity of 135 million and change. And the next thing we're going to look at are T accounts. T accounts provide a good illustration about how complex transactions affect various accounts. Let's first discuss how T accounts are set up. So step one, we're going to make a T account by making a T shape, which we will then debit or credit. Basically, you would need a T shape for each account, which will have amount added or deducted from it. Then we're going to have an account name in step two, and you can kind of see that happening here. Write an account name above the horizontal line of each T shape. For example, your first T might have cash written above it. The left side of the T is the debit side, abbreviated DR, where you will record debit amounts for each account. The right side of each T is the credit side, abbreviated CR, where you will record credit amounts for each account. At this point, your cash T account should look something like this. So you have cash as the name, you have a T shape, and the left side of the T shape is the debit, the right side is the credit. Step 4, add beginning balances to each T account. These are the amounts which exist in the T account prior to you starting your work. For example, the firm might hold $1,000 cash at the start of the year before any transactions happen. At the start of the reporting period, some accounts will naturally start from a zero balance. We will learn more about this later. Step 5, add debit and credit amount to each T account based on the impact of each transaction on that specific account. For example, an equipment purchase using cash would create a credit balance, decrease in asset, in our cash T account, and a debit balance in our equipment T account, which is an increase in asset. It is a good idea to identify which transaction each number in your T account come from. A common practice is to add lowercase letters in front of each number. So you're going to see that happen as we go into our first example with T accounts. And finally, step 6, sum up the amount in each column for all the T accounts and calculate the ending balance or total at the bottom. A debit end balance or total should be written on the left side, and credit balance or total should be on the right side. If there are numbers on both debit and credit sides in the same account, you should take the net amount, so subtract debits from credits or credits from debits, and write the number on the side which the ending balance ends up as. For example, your cash T account may end up looking like this. So you see here, we have a beginning balance, we have a bunch of transactions, each one is represented by a letter, both on the debit side and credit side. At the end, when we total them up, we take all the debits minus all the credits, and we end up with a debit balance of 800, so we write it on the left side as our ending balance on January 31st, or end of the month. So we're going to try a new practice question for a startup with 8 blank T accounts and a list of transactions. And you see them here. So what I want you to do is take a few minutes, read through the transaction, and try filling in these T accounts. You want to set them up with a name. You have the option of writing debit or DR on the left and CR on the right, but you don't necessarily have to do that. That's optional. But give this your best shot, and we will cover this exercise in the following video.